Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And I am so excited to be joined by a special guest here today, Ben Fraser. Ben, welcome to the show.
Thanks for having me on. Looking forward to it.
Yes, well, Ben, this is your second time back. We're going to talk about the Lewie 200 units in Overland Park, Kansas. But before we do that, tell us a little bit about yourself, how you got into the multifamily space and where you're at today.
Yeah, well, thanks. I'm the Chief Investment Officer over at Aspen Funds, and Aspen Funds been around about 10 years and have invested in lots of different asset classes. Actually started in the distressed debt space, kind of coming out of the 08-09 crisis, but then have evolved into multiple verticals, multifamily being one of them. So we own over 1,000 units in a few Midwest markets and have about $500 million of assets across all of our verticals. So yeah, this is it's fun because the last podcast we did was a deal that we did at the beginning of closed at the beginning of 2023, and this is the only other deal we did. We closed at the end of 2023. So the only two deals we did you get to hear about, but it was hard to do deals last year, right? And it's still a little hard. So I'm happy to dive into how it all came together.
Excellent. Well, and that's just an indication of the environment that we have been in for the past 18 to 24 months. So let's dive into the Lewie, again, 200 units in Overland Park, Kansas. Let's start off. When did you close this deal and what was the purchase price?
Yeah, so we closed it in December of 2023, so just a few months ago. Our purchase price was just over 44 million, so a little over 200 a door.
Okay. And in Overland Park, Kansas, that's a pretty affluent area of Kansas City, correct?
Yeah, it's the number one submarket from an income standpoint. Got the best school district in the state, and great for anyone that has families that want to go to public school. So it's actually where I grew up, as in Overland Park. So that was one of the attractive pieces of it, is knowing the area very, very well.
That's actually where I flipped several properties actually within
Oh,
Overland Park.
really? Okay, yeah.
Definitely, yeah. A bulk of our portfolio buy and hold rentals were in the Kansas City metro area, so did a lot of flipping in that area.
Okay, nice.
So when did you find this deal? So you closed on it in December. When did you find it and how did you find it?
Yeah, so our model is generally co-GP. So we had another partner on this deal that's more operationally focused, more deal finding focused. And so they were the ones that found it. It was on market. It was marketed through CBRE. And our partners on this one, they've been bidding on assets in the market for the past 2 years. They were, never the highest price, but were disciplined in their building good relationships with the brokers. Invest in final on a lot, and then finally caught the dog that caught the car, right, chasing it, and we're like, oh wow, this is a big asset. It was a big jump for them. I think they had about 600 units, and this is a 200 unit property. And so it was a big jump. So they brought us in, and so we're helping with the back office with asset management. And obviously the capital structuring is really where my background comes in and help to close the deal.
Okay. So I'm curious to know, like, how did you structure the contract then, like, in order to get the deal closed? Was it just being the highest price, or like were there other terms that helped you close the deal?
Yeah, it wasn't the highest price. This was a group that owned the asset, was mostly coastal assets. They were wanting to get out of the portfolio, but I think they liked the idea that these are we're local to the market. We understand the value here, and we're happy to move. So it's really honestly the brokers that sold us, as hey, these are we've never not closed a deal, and just in this environment, I think it was that was a big deal, because this was we assumed a Fannie loan and had done a couple other of those assumptions, and it's a complicated process. And so I think having the assurance that we'd done that before helped a lot.
Mhm. At what point in time did you walk the property before putting in the offer?
Yeah, I mean that again, the initial walkthrough was with our partners. They obviously walked it before they put the final offer in, and then we walked it many times during the due diligence and closing process.
Okay, so tell me a little bit about due diligence, and I guess let's back it up a little bit. How was the contract structured? How long did you have for due diligence? How long did you have for close? Did you have any extensions? And and this being a loan assumption, right? And we've heard about several of these structures over the past year, but tell us how you structure the deal.
Yeah, so it's nice. It's a double-edged sword when you have a loan assumption because if you can make the contract contingent on approval from Fannie, then that can give you a little bit of outs if you're running into the end of the time. But the downside is you're at the mercy of Fannie's approval process, which is a big wild card, and especially at the end of the year, it's just a little bit of an unknown because they have a big, you know, a lot of deals close obviously at the end of the year, and a lot of these assumptions happen, so they were very backlogged. So our initial contract was, I have to go back and remember all the details on it. I think it was 60 days of diligence, 30 days to close, and then no, it's 45 days due diligence, 30 days to close, and then 30-day extension if we needed it. So we ended up using the extension, and I mean we can get more into all the nuances of what went well, what was hard, but as you know, very difficult to be raising capital in the last quarter of 2023 with interest rates is where they were, and just the capital markets were, excuse me, were a lot tighter, and so it's hard to get investors excited. It was a big equity raise because the Fannie assumption, it was only at about a 45% LTV. So we had a lot of equity to go raise, and had a decent sized capital improvement budget. So it was all in. It was $26 million of equity that we had to go form in a very short period of time. And so we ended up having to actually negotiate another 30-day extension. By that point, we already had 7 figures of hard money in the deal. And so a lot of heartburn at the end of the year. It's kind of a funny story, kind of a memorable story now, but I think I've told you I have 4 girls. They're all in the ballet. They're in a ballet performance that they roped me into being a volunteer in. So in between performances, I'm trying to get on the phone with Fannie for the last closing docs, and got it done at the 11th hour, literally the 2 days before end of the year.
Oh my goodness. Heartburn for sure.
Yeah.
Well, before we jump into the deeper details of the loan assumption and then also the capital raise, because we definitely want to pick through those details. Let's go through due diligence. Okay, so those first 45 days, your partners have already had the property under contract. They've walked it. Now you guys are brought in. Tell us how due diligence went. Like, were there any, especially physical due diligence? Was there any surprises there? Was the property as you thought it was going to be?
There weren't any huge surprises. There was, it's a 99 build, so it's a little bit newer vintage, and it was very well maintained. Um, so that was part of the appeal. We walked obviously every unit, did a lot of the physical due diligence on the clubhouse and everything else. They had just recently done all the parking lots. Roofs are in good shape. The big CapEx item that we were kind of struggling with was the landscaping. So all of the sprinkler system had blown out, and it's a huge property from an acreage standpoint. And so it's a big number. We decided to put that in our CapEx budget. Just we felt like having really nice grounds and just a well-maintained property, just from a aesthetic standpoint, was going to really help get to the rents we needed to get to. So we did do that. That was probably the big kind of unknown going in, and a little bit of a surprise, but again, weren't too worried about that. And then walked all the units, and the cool thing with this property and why we liked it, one, it had assumable debt, and we had a 3.9% interest rate with Fannie, and so that was attractive. Obviously, is kind of an initial part of it, and then the other part was 112 units of the 200 were already renovated, and they were already achieving on the majority of the units our kind of pro forma rents just to achieve our business plan. And obviously, we think we can get a lot higher than that. So it was really just understanding the level of renovation that the remaining kind of 40% or so needed. And yeah.
Excellent, excellent. So with it being a 99 build, and let me sound this back to you, it sounds like it was a little bit of a value add. Like you had 112 units already renovated, so you're going to take the remaining 88, get them renovated, and create value add from there, like bump the NOI up. Do some of the CapEx, including the grounds. Any other part of the business plan that we missed there that might be interesting for the listener?
Yeah, I mean, so the property is they're mostly all townhomes, so they're very large. Most are 3 bedrooms. They got garages. It's beautiful property, like I said, in the best submarket. So there's a lot of families there. So part of our improvement plan, included what are the amenities that families want? How do we attract more, families that are looking for a nice property in the school district they want to be in? So we're, putting a pickleball court in. We thought about putting a splash pad in, decided against that, but we have a nice pool. We're going to expand the whole pool and patio area, make it a lot more, just pretty much double the size of it so that it can, host more parties and people's hanging out there and enjoying that. And yeah, and then just improving the clubhouse, kind of updating it. The 99, it's funny that that's now almost 25 years ago now, which is just wild to think about. But it definitely needed some updating just from some of the just aesthetics of it. So it's kind of modernizing a lot of that.
Excellent. Any surprises on the financial due diligence for the property?
No real surprises. Like I said, is well maintained. It was well run by a pretty large operator. They had in-house property management, so they had a lot of. I mean, all the information we needed was pretty. We were able to get. So obviously audited the rent roll. And the other great thing about the property is they've been running about a 95% occupancy rate for a long time. And even since takeover, we've still maintained a 95% occupancy. And it's just, again, not a whole lot of supply in the market. In fact, no new supply coming online. And again, great property. So it was no big surprises. It was really just proving out market rents and making sure we could kind of hit the business plan with the CapEx program.
All right. So you have the loan assumption, 3.9%, 99% interest rate. Fannie Mae, so public debt, 45% LTV. Is that what you said? Okay, 45% LTV. I'm curious, do you still have time left on the interest only period? And if so, how much? And were there any lockouts or extensions in there that you renegotiated?
No, it was full IO for the whole period or the term. So that was the other kind of wrinkle in here that we could talk about just from a strategy and structure standpoint. But the 3.9% interest rate, it was full IO through the term, but it expired or matured in about a little over 3 years. So we really needed to underwrite this first to that kind of 3-year time period to make sure we hit the business plan, and then refinance into the debt at that time, or sell. So depending on what the market's doing, we'll kind of see. But that was kind of our first big hurdle we had to overcome. Is this achievable business plan within 3 years?
Okay. And then raising capital on the deal in the middle of the holiday season. How did that go?
Oh my gosh. I always say I'm not going to do a deal at the end of the year and holidays, and then every year I've done it. So it's, I don't know if I can get away from it, but yeah, I mean, it was a few sleepless nights because it was a big number, but really believed in the asset and the business plan. We ended up bringing on some preferred equity. And so, it can be pretty attractive with the preferred equity. One, to bring up the leverage to kind of a more normalized amount. I think we brought it up to 67% roughly, loans to cost, combined loan to cost. And with Fannie in front, they do not allow a hard pay structure. So the preferred equity has to be willing to remove some of their takeover rights, some of their default rights. And so it really becomes a true soft pay. And, we were able to negotiate some of those things just by nature of the senior not allowing it. So that helped a lot. I think they wrote a $12 million check. And then we still had to go raise another 16. So it's $28 million now that's all the numbers come back to me that we had to put together. And we ended up deciding that we're going to syndicate the whole 16. But again, didn't know how that was going to go, especially at the holidays, especially, multifamily is just harder right now. A lot of people are having multifamily deals that aren't doing well. And so, in their portfolios. And so it's just, it's some people are a little bit spooked, but we're able to raise a lot of that, and then had built some relationships with some larger institutional investors and brought in a larger group that wrote about an $8 million check as an LP, and then we raised the other $8 million from retail investors. So it was a lot of things to put together, a lot of puzzle pieces to fit together, but worked it all out and got Fannie to approve it and closed it.
Awesome. Okay, so how did you structure this with your limited partner investor? Like, what was the preferred return? Were there any IRR hurdles in there? What
Yeah,
was the back end split?
yeah, great question. So it was kind of standard. We had two share classes. One was 50,000, the other was 500,000. And our standard share class at 50 was a 7% preferred return, 70-30 split up to an 18% hurdle, and then it was 50-50.
Okay. And then what kind of fees did you charge to this deal?
These are pretty standard. We charged an acquisition fee of 2%, asset management fee of, I believe it's 2% of EGI. And then we're doing construction in-house. So construction management fee, I believe that was 7%. And I think those are the only fees we have in there.
Mm-hmm. Now, what I find unique about this deal is that, another capital group or had an operating group had found the deal, realized that they needed partners to close, right? Like the real estate truly is a relationship business. They bring you guys in, and then you guys are helping with the capital structure, and you guys bring in the preferred equity, the other institutional investors. That's the value add here. I'm curious to understand, and please share with us as many details as you're able to. How did you, between the operating groups, structure the general partnership?
Yeah, so what we generally do on these kind of deals is identify what are the key roles that the general partners are responsible for in a deal. And then we will kind of allocate the percentage that each group is bringing to that particular role. And then we'll allocate what's the value that each role brings to the whole general partnership. So that can shift based on, was it a hard deal to find, or was it on market? What was the capital structure environment like? What's the asset management going to be like, et cetera, et cetera. So we kind of just go down through and we structure, just kind of split the GP based on kind of what those allocations look like.
And I'm curious, and I'm sure listeners will want to know too, with the challenges that you ran into with a loan assumption, the difficulty of the capital raise, during the holiday season, are all these the general partnership structure? Did you, have that split allocated at the very beginning, or was that a negotiation throughout the closing of the project?
Negotiation. So we kind of, here's kind of where we think it's going to be based on what we know right now. And then we did kind of a final true up once the deal closed.
Mm-hmm. And I think that is, thank you for sharing those details, because I think that is something that keeps a lot of people sidelined, especially when they're getting into multifamily real estate. They figure, like, if I bring in a partner, how do we value the the skills that each one of us are bringing to the table, and what if something changes? Am I kind of shooting myself in the foot in a way? And I love hearing that you guys had your ideal, like, this is what we think it's going to be, this is how it actually ended up, and then you guys had the ability to communicate and true that up, as you said there at the end of the deal.
Yeah, it's a great point because in any partnership, right, it has to be some give and some take. And I think what we've learned through doing a lot of these types of deals is setting expectations on the front end of, are we all in agreement that these are the roles and these are kind of the value that they bring to the deal? Where we kind of, line out our participation in that role between groups might change depending on how the deal finalizes. But if we're agreement on the kind of general framework, it's a lot easier to then say, hey, here's where it ended. I think, this seems fair. And there was no real pushback. Everyone was in agreement. And I think, again, that's also a good, on the front end, a litmus test on, is the partners that you're working with going to be reasonable? Because there's always going to be things that change, that shift, not only from just trying to close the deal, but even managing the deal. And on an ongoing basis, you need to be able to um, be flexible and work with people that are willing to give and to take when necessary. And it's, that to me, that's a really big key of a good operating partnership.
Yeah, how can you create a win-win relationship
Yeah.
there?
Yeah.
Amazing. Now, I'm curious, since we do have a little bit of time, how did the first couple weeks or first month of takeover go on this property? As expected, or were there any surprises?
I will say, knock on wood, because we're still kind of early in it. It's going really well. I mean, I keep waiting for like the shoe to drop because, as you know, I've been doing a lot of these deals, and I've done a lot where it's big surprises. I mean, we had one acquisition, not this one, where we took over a property, and the property manager brought in a new on-site manager, and we're doing these weekly calls. On-site manager is everything's going great. Collections are going well, and all of a sudden we start noticing kind of bad debt expense trending up. Well, fast forward about 6 weeks later, find out that this guy was fabricating all the numbers, and we weren't at 92% occupancy. We're at 75% occupancy. And we had no idea. And that's why the bad debt was ticking up, obviously. So, I've had a few experiences like that where you get kind of brace yourself, and then just it's a big deal to take over. Thankfully, um, it's not a super heavy value add in the sense of we're not clearing out all of the units, sending notices, and doing a big renovation. We're just going to be renovating the remaining um, as the leases come due, and so it's more of a you know easy paced renovation program, and we're not trying to do much to disrupt the current tenancy. So all in all, it's been good. We're actually trending right now at 95% occupancy still. And the one kind of wrinkle that we had to figure out. So here's you're jogging my memory again now. So one of the unique things with Fannie, aside from you have to check the box on experience, you have to check the box on financial, you know, wherewithal. You have to check the box on structure, check the box on all the different things. And then they also need to approve your property manager. So our operating partner, they vertically integrated property management. They've been doing that for several years on other properties. They wanted to take over property management on this property. We were open to that, and we had been very forthright with Fannie, but they it was kind of a surprise to everyone, but they at the very last minute decided not to approve them as property manager because internally, and what we heard was, as Fannie's having some of their assets in their portfolio start to struggle a little bit, right? As there's a lot of stuff going on in the market, they're going for much more experienced property managers, and kind of they're beefing up the requirements on who can operate an asset. So that was kind of a last minute change. So we're kind of scrambling before closing. And so what ended up happening actually worked out really well is the seller, who was vertically integrated and was managing the property themselves, left their management company in place, and they're actually still operating the asset as of today. And it gave us enough time to go and interview and find the right property manager that we want long term. And so they're taking over at the beginning of next month. So it's worked out pretty well. It was a little bit of a wrinkle at first, and then obviously you get a little bit nervous with the person or the group that just owned the asset. They don't care about it anymore. So off of their balance sheet, and they're still the ones managing it. So you kind of got a little nervous, but they were great, very communicative. And we're actually going to be hiring most of the employees that were operating the asset on a day-to-day basis with the new management group. So it's going to be pretty seamless. And again, knock on wood, it's going pretty well so far.
Well, that's awesome. I've got two questions to wrap up with. And maybe you've already answered these. What did you find easy during the process that you thought was going to be a little bit harder? And what did you find that was harder that you actually quite honestly expected to be a little bit easier?
Oh man, that's a really good question. I think the going back to the question you mentioned earlier, the comment of partnerships, it ended up being a pretty seamless partnership in a lot of ways, very complementary between our two groups, and it's continues to work very well. So that was kind of, it just fit really well. That was the easy part, and to me is kind of you know the baseline for even deciding to do the deal. But then we kind of expected the capital raise to be hard, but it was way harder than I anticipated. So
I've been there. I know what you mean.
yes, yes.
Oh man. Well, Ben, thank you so much for sharing your experience and insights with us here today. If people want to find out more about you, how can they do so?
Yeah, feel free to check out our website, Aspen Funds. It's at aspenfunds.us. We also have a podcast as well called The Billionaire Podcast, so Invest Like a Billionaire. And you can check that out. It's more limited or focused on limited partners, education around passive investing, but we have a lot of fun doing that show.
Excellent. Well, Ben, thank you for sharing your time and knowledge with us here today. We look forward to hearing about your future deals.
Awesome. Thanks for having me.